Hi, I'm Nikhil Raghuveera, and I'm a non-resident fellow at the GeoTech Center. I currently work at the Equal Justice Initiative, and my work at the GeoTech Center focuses on the intersection of technology, social inequality, and systems of oppression.
In this presentation, I'll be talking about central bank digital currency and the opportunities and limitations for financial inclusion. So I'll first talk about what the major causes of financial inclusion and financial exclusion are, and then go through exactly how a central bank digital currency can fit within this framework and contribute to financial inclusion. And then I'll conclude with next steps for regulators. So it's important to note that financial exclusion is rooted in marginalization. Generally, it comes from systemic failure around lack of access to government services, and a complete inability or ignoring of certain communities, and historical inequality and wealth and lack of wealth. And so really that is the primary cause of financial exclusion, is simply the lack of wealth. People simply don't have enough money to really justify having a bank account. On top of this, you have the lack of robust financial institutions, particularly in emerging markets that aren't widely distributed and largely inaccessible. Financial institutions may also be unwilling or unable to engage with certain people. And some communities may simply not have the education or tools to really understand how to navigate a financial system. And so what this has meant is that you're seeing a situation where a number of people simply don't have access to financial services. And in a world of widening economic inequality, this is only getting worse. And what this has meant is 1.7 billion people don't have access to a bank account, and billions more don't have access to other financial services, such as a bank account, or beyond a bank account, also kind of savings accounts or loans. And the concern here is that this really means that there's an entire inability for people to generate wealth, both for themselves and for their families. And so CBDC, or central bank digital currency, can help to address some of these failures. So first, I can go through what a central bank digital currency actually is. It's basically a digital currency that's issued by a central bank, kind of like traditional fiat cash. The difference is, of course, that it's in a digital form, and it's backed by the full faith and credit of the central bank. So there's two types of central bank digital currencies. There's a wholesale and a retail. A wholesale is one that is primarily used by financial institutions for interbank payments and settlements. The one that I'm really focusing on here is the retail form. And a retail central bank digital currency is one that is used by the everyday person. It's used for kind of the general payments that you normally use cash, or a digital payment platform like Venmo or another form. And so for this, how it works is that individuals have accounts on the central bank like they would with a traditional financial bank. And what this means is they're able to get access to it in a way that's different than how it's currently done. And the reason is that with a traditional bank, they're profit motivated. They're not in the interest of necessarily providing access to everyone. They're focusing on maximizing profits. And the way they maximize profits is on credit risk. They're not actually holding the amount of cash that they need to give money out to everyone in the case that everyone needs their money back. They're only holding a certain amount of it. The rest of it they're using for loans. A central bank is different. A central bank doesn't have the incentives for profit, and it's also able to actually print money. And so it doesn't face the same credit risk concerns that traditional financial institutions have. And this means that anyone could have an account on a central bank, whereas they may not be able to get access into a traditional financial institution. And so how the system would work is basically people would have accounts on the central bank, and then they would use that account in which they would hold their digital currency, and then use, let's say, a mobile application to make payments with one another. And so a CBDC can offer an alternative to fiat cash for a new digital system in two ways. One, it transforms the digital payment system, and two, it's able to create financial history and digital identities. So going through what it means for the transformation of a payment system, it's able to create a digital payments ecosystem that's not reliant on intermediaries. What this means is you're able to process transactions faster without going through different hurdles, without going through different groups in the middle. And it's also cheaper. This is particularly important for people who live in rural parts of the world, as well as women who generally aren't able to access traditional financial systems, as well as lack of safety of using and holding lots of cash. A digital currency also allows for an interoperable system with a centralized point of account. Right now, you've seen different payment providers, different financial providers, and all of them are interfacing with one another and trying to interact. The challenge, of course, is that you have different systems, and that slows down payments. So, for example, if you look in the United States, it took months for the COVID stimulus check to reach people. And the reason for that is because you have all these different systems that a stimulus check has to go through. By creating an interoperable system, you're also then able to integrate fintech and traditional financial products to create a broad ecosystem for domestic and international payments. And then thinking about financial history and digital identities, a CBDC account serves as a form of digital identity. And so this incentivizes people, and this incentivizes governments to begin creating digital identities for people. In addition to that, it also creates shared data standards and common data standards, which can then be used to apply for other government services. And then just as importantly, a CBDC account allows for an access and pathway to building credit history. There's a bit of a chicken and egg problem when you think about traditional access into the financial system. You usually need credit history for a number of financial products. But if you haven't been able to use those financial products, you're oftentimes not able to generate credit history. And so a CBDC account is able to provide that initial point of access, which you can then build upon to basically build out a credit history. So right now we're thinking about COVID-19 and we're thinking about the immediate implications of it. But I think the immediate implications are basically demonstrate the systemic failures across the world. In this case, we can also look at the problems in the financial system. Right now, we're looking at a case where you don't have direct engagement between a government and people. There's intermediaries that sit in the middle. What this means is that when a government is trying to implement stimulus programs, they have to go through intermediaries. A CBDC is able to change that. It's able to create a direct engagement between government and people, so you can have direct stimulus programs such as cash transfers and automatic rebates. COVID has also disproportionately affected certain communities that have already been historically marginalized. And so a CBDC is able to kind of create targeted interventions towards those communities and also bypass intermediaries that have already been historically excluding them in the first place. And then lastly, COVID has shown that you can't necessarily rely on in-person interaction, and that is what cash is. And so a CBDC is able to create the conditions for an online and mobile payment system and support network effects for future innovation when thinking about a broader transformation of the financial system. And so it's important to note, though, that CBDCs are a technocratic solution. They don't solve the underlying causes of financial exclusion. And the underlying causes are access to internet, lack of trust, and historical lack of wealth and inequality. And so given that, it's only one tool. A broader transformation is needed for society for really thinking about financial exclusion. And this goes down to things such as voting rights, goes down to tax policy, religious persecution, sexism, marginalization of minority communities. The list goes on and on. But the point here is that we can't expect CBDCs to solve most of these problems. And so given that, the way to frame CBDCs from a technocratic solution into a movement for a broader change is defining an aspiration for a national right to a retail CBDC account. And this isn't novel. This aspiration is something that has kind of already been put in place in some countries. So France, for example, has a national right to a bank account. And in this case, the CBDC system should have something similar. And I agree, even I acknowledge that an aspiration doesn't necessarily mean that it will happen, right? And so we also know that having a right to something in a country doesn't necessarily mean that right is enforced. But at the least, a right for a retail CBDC account puts in place the conditions to move towards it, and at least allows for a process around policies to be implemented around it, litigation, as well as broader social movement. And so the key takeaways here are that CBDCs can contribute to financial inclusion, but they can't address the root causes of financial exclusion. More work is needed to be done around that. They can reshape the relationship between central banks and people. allowing for a more direct engagement between governments and people. But most critically, it's important to have a national right to a CBDC account to move from a technocratic solution to a broader social change. So when thinking about next steps for regulators and policymakers, unfortunately, most of CBDC development, if you look at reports published by the Bank of International Settlements or the Bank of England, the design frameworks for CBDC have primarily focused around cybersecurity standards, things around financial stability, but very little on financial inclusion. If you look in the reports, it's maybe a paragraph in the entire report that talks about financial inclusion, and no real mechanism or framework to actually think about how to go about achieving financial inclusion. And really the way to do this is elevating the voice of the people who are excluded. If a CBDC is developed and launched from a top-down approach, it's not going to solve financial exclusion. If anything, it's very likely to make the situation much worse, creating a digital divide in which certain communities are only further excluded from the financial system. And so what governments need to do, both from a regulatory and policy-making standpoint, is first determining the key historical causes of financial exclusion, working directly with communities and people who have been excluded. And then creating a network and a partnership with those organizations and people. And by doing that, then bringing in private sector to think about how CBDCs can specifically contribute to financial inclusion for these people who have been excluded. Once you've assessed that, then you can start testing a digital currency in one of these communities. And the test would be on a closed network. And the purpose would be to collect data sets and information on how a CBDC specifically would help alleviate the issues that these communities face. By doing this, you can then create a new framework for a CBDC, building on the work of other central banks to create a CBDC system that centers the needs of people who have been excluded. And so that concludes the presentation. When thinking about financial inclusion or how it might undermine it, so I touched on this a little bit earlier, it was CBDCs can promote a digital divide. There's a number of people who don't have access to internet, who don't have access to mobile phones. And so if a country starts shifting towards a CBDC system, those people who don't have access to this underlying technology will just be further excluded from the financial ecosystem. It also has another problem around financial inclusion is the systemic financial risk that it can have, right? So we don't exactly know fully yet how a CBDC might play a role in terms of moving people from financial institutions to the central bank. So what I mean here is if you have a retail CBDC, what is the incentive for people that still hold accounts on traditional banks rather than holding an account with the central bank? And if you see a mass exodus of people from traditional financial institutions, that can actually undermine the entire financial system. So that's the systemic risk. In terms of weaponization, this really comes down to surveillance and what a government might be able to do with CBDC data. You'll be able to, there is a possibility and an ability for a government to entirely track the transactions that are being done across people and also block payments entirely. And so that's something that's actually a key concern. And if you look at the work that China is doing right now, there's been a strong discussion about the extent of data that China will be able to collect from their current tests for central bank digital currency. I think in this case, I mean, the initial development of a CBDC would be done by a central bank. You might receive support from from private sector, but this development and launch would be done by the central bank. That being said, if you're thinking about a broader payments ecosystem, you have to have private sector play a role in this, and they should be working with the Financial Stability Board, Fed, Treasury, groups like that. Those are obviously US entities, but similar organizations in other countries. The main point here is that the regulatory bodies set up the operating framework, which private sector then operates in. The central bank digital currency kind of sets the guardrails for the common system, and then everything else would work around that and integrate with that. Still need cash. Right now, we can't expect everyone to turn to CBDCs, particularly not immediately. There's people without internet or phones. There's distrust and discomfort around the idea of a digital currency, right? It doesn't really feel real. There's also older people who may also not be comfortable or able to just kind of pick it up. And there's a lot of financial education that needs to be happen first. And the reason why you have to have cash, because if you completely get rid of cash, again, a lot of people will simply not necessarily be able to pick up a digital currency immediately. So what we'll need to have is kind of a two-part system where essentially we'd have both cash and a digital currency operating. And then down the line in the future, we'll then be able to roll out cash and replace that with a digital currency. The things here, of course, is a risk that fewer places start taking cash, which further excludes people, right? You already know there are already restaurants around the world that, for example, have stopped taking cash entirely and only take credit cards. And that means that people who don't have credit cards actually just can't even go to the restaurant. And so in this case, what we actually really need to start thinking about is a more robust safety net system and incentivizing businesses to still take cash and still continue to supply cash and making sure that it is accessible for people during the transition. One, of course, is targeted government stimulus and cash transfer programs. Right now, if you look, a lot of stimulus programs still operate through financial intermediaries. So in this case, a central bank digital currency allows for a direct transfer. Tied to that too, of course, is the data implications, as far as you can actually understand how people are spending potentially, or you can at least see who are the people that really need support. So you're able to create more targeted interventions. The other thing too is you can better control interest rates. If you're thinking about cash, the way a central bank sets monetary policy by printing money. This of course requires, and then that interest rate then has to then be applied by financial intermediaries to other institutions, whether that's private sector companies or people. Central bank has no control over how the interest rates that are set by banks. And so in this case, a central bank digital currency allows for a better way to set monetary policy, a better way to control interest rates, and a better way to manage the supply of cash relative to demand. Then the last thing, of course, is pushing a government to start really addressing the digital divide and avoiding people from being further excluded from kind of technology as a whole. It can actually have a number of downstream effects across all those factors you just mentioned. So for innovation, it basically puts in place a framework, right, for new financial products that are better integrated and don't necessarily rely on financial intermediaries. So you can see scenarios where you might have possible micro lending or community loan funds that entirely use the system without going through financial intermediaries. That being said, you can also see the integration and creation of entirely new financial products by major financial players. The point here is that you're able to create an entire new ecosystem that basically modernizes what we currently have, and you're able to create faster payments and systems that then tech companies can actually build on. In terms of economic development, you have, of course, targeted stimulus programs, digital identity, right? And so there's a number of people who don't have any form of ID. And so this does incentivize governments to start thinking about a form of digital identity. It also allows for the development of credit history and the broader digitization of a country. For national security, I think this is a particularly important point. So if you look at our current payment system, there are vulnerabilities, particularly on cybersecurity. So for example, North Korea hacked the Bangladesh Central Bank in 2016 and stole about, I think it was about $200 million. And so there is actually a desperate need for us to improve the actual resiliency and security of our payment system. And I'm not saying that a digital currency automatically does that. If anything, there's going to be a lot of additional vulnerabilities. But I think it also does push for governments to start thinking about how it can create a more secure payment system and modernizing that into one that better operates today. That's particularly important for national security. So the biggest one is still determining the design. How can you make it effective, scalable, and secure? I think there's still a lot of work that needs to be done on that. Interoperability is still a huge challenge as well. You need to have kind of consistent infrastructure, code language, standards, relevant regulatory systems. You pretty much need to kind of rethink, you pretty much might need to reconnect the entire payments infrastructure. And so that actually does require a substantial amount of work, because that's not just, let's say, the US government doing it or the Chinese government. It's, broadly speaking, the entire world. And it's all of the private institutions that are also operating in this tool. So it requires a substantial amount of change of replacing an existing and sprawling system. One of the other obstacles, of course, is like what the technology should be in terms of kind of thinking about cryptography, programmability, data sharing, and decentralization, whether it should be centralized, whether it should be decentralized. And so there's still a number of different hurdles that need to be crossed in terms of how is the system actually going to operate, and how do we go about really implementing it. And if that's, you start scaling up from, you start pretty small and then you scale up from there. And I think there's some lessons from China on that, in that they're piloting a system that's using a couple different banks in a couple of different cities. And I think that's what you'll probably need to have, but this is something that's going to take probably a decent amount of time. Thanks so much for this. Really enjoyed discussing CBDCs with you and the opportunities for financial inclusion. And look forward to seeing what else happens in the future, both in the United States as well as the rest of the world.